All right, well, thank you very much, Rich, and good evening, everyone. Welcome to our first in a series of online gatherings where we are going to discuss the economics of agriculture during this unprecedented pandemic that we're currently in of the COVID-19. My name is Briggeman. I'm a professor in the Department of Agricultural Economics, and I'm also the director of the Arthur Capper Cooperative Center. And I have the good pleasure to kick us off and talk a bit about the macroeconomy, provide an update about what we know currently, and how does this all flow through and affect you all in agriculture. So I'm going to draw a bit on my background. Before I came to Kansas State University, I worked for the Federal Reserve Bank of Kansas City as an economist, and this was during the 2008 financial crisis and then the Great Recession. So some of the training, I guess, I had there, I'm going to hopefully bring to here and try to make sense of some of these numbers and again, try to bring it back to you here in Ag. Just a little bit about the format of this series, because we are going to have other webinars going forward. These slides are available. Rich emailed them out. They're also going to be available on Ag Manager. I'm going to go through this fairly short presentation. Don't have enough time to go through the entire update, but wanted to hit some of the highlights for you all. Also, too, I do have the group chat open. Rich and myself are going to be monitoring the chat as we go. So if you have any questions at all as we go along, please type it in. Rich can stop me or chime in so I make sure that I can get it. My presentation style, if you've ever seen me present in person, is to be very engaging and take questions as we go. So please do not hesitate at all to send in a question as we go along on the group chat. At the end of this, of my prepared remarks, we do have some other folks on who are participating in part of this series. And in fact, I think it's a good time to show this. So here for the next few Thursdays in a row at 7 o'clock Central Time, we're going to have additional webinars. Myself, I'm kicking it off with the macroeconomy. Dan O'Brien on April 2nd will be talking about grain markets and planting intentions. Glenn Tonzer will be talking about the livestock markets. And then Michael Taylor will, on April 16th, have a discussion on land values about what this pandemic means. However, Dan, Glenn, and Michael are all on the call at this time. And when I get through at the end, we'll have a slide of questions, and that's just kind of think of it as a free-for-all. If you have any question at all going on with this pandemic, what it means for agriculture, we certainly have some various experts here who will chime in with video chat and help out. All right, so with that, let me go ahead and get started with my presentation. Okay, so the question out there that is pretty rampant within the financial news is the COVID-19 pandemic. Will it negatively impact GDP? So gross domestic product, I think the answer to that is clearly yes, it is going to have a negative effect, but by how much and for how long? That's what everybody is wondering about at this time. So whenever I do a macroeconomic update, I go back to Macro 101, and I think of Y equals C plus I plus G plus NX, or think about Y being our gross domestic product, C is consumption, I is investment, G is government spending, and then NX is net exports. So I pulled down the 2019 numbers from the BEA, and you can see them here on the screen. In 2019, our economy was just over $21 trillion. And you can see very clearly we're a nation of consumers. About 14.5 trillion comes from consumption, or 68% of our total GDP is driven by consumption, and then everything else, investment, government spending, and net exports is there. So when things come in and affect consumption negatively, that really flows through and hurts us. And this pandemic has had a huge impact on things like tourism. Tourism is estimated to be about 2 trillion, just over 2 trillion, in our overall economy, or 10% of our GDP. If we look at things like food, services, the food service industry, that's roughly 1 trillion. We have hotels, we have airlines, we have durable goods, non-durable goods. Everything is being affected by this pandemic and causing a negative impact on consumption, a big pullback on that. And that's what causes these economic forecasts to be, quite honest, just kind of all over the map. We're all trying to make sense of this and figure out how bad is this contraction going to be. So I pulled down just some forecasts for the 2020 second quarter annualized GDP, so an annualized growth rate for just this particular quarter we're currently in. And this was before March 21st. And really, I found the good, the bad, and the ugly. Wells Fargo had a good retraction of -3%. The bad that I found was Bank of America of an annualized growth of -25%. And then the ugly is -50%. And this is of note from James Bullard, who is the president of the Federal Reserve Bank of St. Louis. He made this comment in a Bloomberg interview that would be quite catastrophic. That would very much hurt if that comes to fruition. Again, these are forecasts. We still need more data to see exactly where we're at. Just to put it in perspective, in 2008, the worst annualized GDP decline we actually received in one quarter was -8.8%. So the fourth quarter of 2008. If we take this on balance, it would seem that most forecasts would anticipate this quarter to be worse than what we had in 2008. Now, why is that? Why are folks really expecting a real significant drop? And then maybe even a real potential big rebound following this? I think the first question that has to be answered, and we need to see some certainty come around, is controlling and containing the COVID pandemic. That needs to add some certainty to the market to get us back consuming, but probably more importantly, get us back working. Right now, the labor market has been incredibly strong during this very long period of growth we've had in the United States, but it took a significant hit last week. And to illustrate that, maybe you've seen this going around, certainly if you follow Wall Street Journal or Bloomberg or any of the others, there was a swift and sharp contraction in labor markets at an unprecedented scale. We've never seen this as long as we've been collecting this data. And that goes in the initial claims of U.S. unemployment insurance. This was from last week. So these are initial people coming in and making those claims. It spiked to a level we've never seen before. It went up for that 1 week of 3.28 million individuals on those initial claims. And just to put that in perspective, to look back in 2008, the highest amount of initial claims that we had was at 665,000. So this was a tremendously high increase. But what's not shown on this graph is, well, this is for the nation as a whole. Who was hurt the most? What states experienced the hardest hit? And one thing that, as we're seeing more data come in from some of the Fed banks, the Philadelphia Fed, the Kansas City Fed, they have manufacturing surveys where they survey manufacturers to get some leading indicators about, well, what are their orders going? How are they proceeding? What's their, how are they doing economically? And pretty universal across all the Fed surveys for manufacturing, there's a steep contraction. So it's not surprising when we look at that 3.28 million that Pennsylvania, Ohio, New Jersey, Michigan, some of our big manufacturing states took a big hit. Large, sharp increases, some of the biggest in the nation occurred there. But also too on the tourism side, California is up at the top. So we see that real significant hit. Now, the question that I have, this is 1 week. Yes, we're trying to make sense of all of this data, but will this continue? How will these U.S. unemployment insurance claims continue? And that's something that we have to wait and collect more data on. But just to give us a bit of perspective, I put here on the graph on the right, the continued claims of U.S. unemployment insurance. So continual people coming in and making these U.S. unemployment insurance claims. And in the 2008 crisis, just our recession, just following that, we got up about 6.6 million. So we've added 3.28 million on, and if that continues on, if you see over here on the right side of our graph here, that, just below 2 million, that'll put us up closer to 5 million if this trend continues. Now, what I don't have up here is the unemployment rate. Just to put it, we were coming off of an unemployment rate of right around 3.4%. As high as, or as bad as the 2008 recession was, the unemployment rate during this period of time, during this recession, it rose to right at 10%. So hopefully we don't hit that mark, but we just need to collect more data to find out. Pause here real quick and just put a note. I like to build my graphs, especially here with audiences. If you're interested in following along and want to collect more information, the St. Louis Fed does a great job of letting you enter in various economic data that you want to collect, and they generate these graphs really quickly for you. So here's the website that if you want to go along and track these as we go, feel free to do so. So with all of this contraction in consumption and labor markets taking a huge hit, we've seen the US government and the Federal Reserve step in and make some unprecedented stimulus packages in different facilities for the Fed to try and stabilize the US economy. Now, I must add to this title, this isn't going to cause a recovery. We need to have labor markets get back to normal. We need to have people working, people going back to consuming. These stimulus packages are meant to help as a stopgap to try to weather the storm so we can move forward and grow as a nation. So the US government passed recently a $2.1 trillion stimulus package, much larger than what we experienced in the 2008 financial crisis. But again, we didn't see this real hit to consumption back then like we are seeing right now. So that 2.1 trillion, there's some arguments for it. We have loans going out to businesses. We have direct relief going to households, supplemental for things like hospitals, all meant to try and stopgap the pain that the economy is experiencing right now. The Federal Reserve has stepped in and is using and is ramping up every monetary policy tool available to them, and even creating some new ones that we've never seen before. In the past, they had been purchasing Treasury securities, but now they have committed to this week buying $375 billion in Treasuries, so U.S. government debt, and $250 billion in mortgage securities, all meant to try to provide stimulus to the economy. That alone, along with the other facilities that they announced, the Fed's balance sheet is going to swell above $4.5 trillion. In an earlier video on Ag Manager, I went through the balance sheet, and you can go see that, but we're going to see a Fed balance sheet of up over $4.5 trillion. They've also restored the TALF, which is from the 2008 financial crisis. That's meant to support consumer and business credit, to unclog credit markets, get credit flowing within the economy. And this is the new one that they're doing, and this will be interesting to see how it works and how it's accepted within the marketplace. They are going to become effectively a direct lender in the market. So typically the Fed, the way they support credit markets and asset markets is going through intermediaries and then also through Wall Street. But in this case, they're actually bypassing that and creating two facilities for sure. That one is aimed at providing new financing for the $6 trillion corporate debt market, and then also a facility at providing financing to existing corporate debt. The third facility that they've proposed, and it's still being discussed, we don't have a whole lot of information on it, is a facility aimed at Main Street. So trying to provide lending to small and medium-sized businesses through this turbulent time. So like I said, this is something that'll be interesting to see, because the Fed, they do have to adhere to different mandates. It's a little bit tighter credit. It's tougher to get a hold of. So hopefully in some ways it becomes a lender of last resort and we never see it and they're able to unclog the credit markets and they can function normally, but they're there just in case. But with all this stimulus and reduction in consumption and uncertainty, and certainly on the stimulus side, there's a lot of questions about future inflation. And I do strongly feel that we're going to need to monitor this because we are in uncharted waters here. So just to give us an idea, because this does change really rapidly, I have put together, again, from the St. Louis Fed website, the 5-year break-even inflation rate. Essentially what this chart says is what is the market's expectation for inflation? Because it is the difference between Treasury securities and then Treasury securities indexed to inflation. And that the difference gives us what the market expectation is. And if we look following the financial crisis, and here in 2016, 17, the Fed has that, their target inflation of about 2%. And we had been hovering around 2%. But we saw a steep decline when the COVID-19 pandemic came out. So we saw inflation really shoot down, at least the expectations for it, for 5 years out. And if we look back to the 2008 financial crisis, it was actually quite a bit lower, as in negative territory, or for deflation was the expectation, which is not good for an economy, was less than negative 2%. Now, if we do zoom in, because I do have the daily here, we can see maybe there is some effect happening within at least the market's expectations for this stimulus package, where we see over here on the right, if we zoom in a bit, you can see that inflation, that 5-year break-in inflation rate, right around the time when these different stimulus packages were announced, we saw that kick up. Now, how high will it go? Is the stimulus too much? Is it too little? Can we pull back the stimulus? Can we make sure that it's implemented the correct way? Well, those are all things we're going to have to monitor and see here, but at least the market feels that we're not moving into a deflationary environment. The last piece here, thinking about interest rates and looking at inflation, is how does this tie back into agriculture? First slide on that. So here, working with Alan Featherstone, he graciously shared these slides, or at least these charts with me. He collects the farm credit bond rates over time. And it's interesting to show this because I think there's some real takeaways that many of you producers and agribusinesses who are on the call, on the webinar here, have probably seen. The question is, will we see this continued downtrend? Will it continue going forward? Where are we heading with that? The first thing I would draw attention to, and I know many of you all have seen this because I've talked to many producers about refinancing their loans, long-term notes, acquiring, making a purchase and getting a great long-term rate that's very cheap. Well, if we look starting right around in 2019, those farm credit bond rates, especially on longer term bonds, and then all the other bonds begin to decrease. And what that has an effect on is the interest rates that we would pay as a producer or an agribusiness on borrowed money, in particular here from farm credit. Now, a lot of that has been, driven down by, the Fed back in October 2019, started buying treasuries again to try to help provide some support to the economy, and that helped to push those rates down. But if we look at where we're at now, we've just recently seen a snapback up, where we see those farm credit bond rates have begun to increase. And if we look here, where we look at the spread between farm credit bonds and the Treasury bill spread, before we saw the spread, so the difference between a farm credit bond and a Treasury bill, to see that there was a bit of risk in agriculture, above what would be considered the risk-free rate, which is the U.S. Treasury rate. We have a little bit of a risk, a little bit of a premium in there, but it had come down off of 15, 16. But if you look over here on the far right-hand side, we see that spread has spiked to where U.S. Treasuries have fallen but we're actually starting to see those farm credit bond rates increase, and looks like maybe we might be returning back to that 15-16 spread. But will this trend continue? Will we see those rates for producers begin to go up? That's one thing that we'll have to monitor and follow. And on that point, why is that happening? What is going on? Why would agriculture have a higher rate? I would draw your attention. I know I have a lot of questions on us to be thinking about, but to that very point, I would look at that very bottom bullet point. And this is a question I don't have a good answer, but it's something that we need to be thinking about. So when we think back to previous economic downturns, how are we positioned today? How is the agricultural industry positioned today? I know when we were going into the 2008 financial crisis, ethanol was coming on. We had growing global economies. If you remember back then, there was a lot of discussion around how are we going to feed this growing world? And also this growing world is having additional amounts of income. So they're going to be changing their diets, eating more protein. We're going to need to feed those livestock. There was a lot of demand pull that was there ready to pull up our prices. The outlook for ag, at least during that time, looked pretty good. How are we today? What is it looking like today? I know a lot of the reports, and Dan can certainly go to more discussion on ethanol and grain prices, and Glenn can talk about livestock. But I think there's some real questions that we need to be asking ourselves as an agricultural industry as we move into this economic downturn. I think for us, we need to be thinking about what are good, sound farm management practices. How can we make sure that we are managing our farm, our cooperative, our independent seed retailer, what bank, whatever it may be? We need to follow good, sound financial management, and we need to put an emphasis on liquidity. We have got to build up that part of our balance sheet to where we have that quick funds capital available to us to get through this time. I won't go through all of these different questions because I did touch on them in my previous talk and discussion with you all of looking about the COVID-19 pandemic. When will it abate? I think that's a really important question for us. That's kind of the key. Labor markets, the stimulus that's out there from the Fed and the government, ag loan interest rates, where are they going? The last part that I would add before opening it up to some questions, and I see I got a question on the chat, and I'll get to that. But just this bullet here, this came in as an early question and I want to, because I did reach out to talk about our supply chains. So I have work a lot with farmer cooperatives, not just here in Kansas, but throughout the United States. And I reached out to that network to say, well, with this disruption, potential disruption at ports, what does this mean for chemicals? What does this mean for seed? What does this mean? Because we're heading into the planting season. Can we get this crop in the ground? And from the cooperative network that I reached out to, what I heard is that there's not a lot of concern about meeting the demands and needs now. As planting gets rolling, as we get started, the chemical, seed, fertilizer, all that should be there now. As if this pandemic continues and we continue to have some disruption, that could affect our supply chain and could raise those prospects looking forward of, will that supply be there? So we need, unfortunately, more information. But from what I have heard right now, that's therefore available to get planting rolling going forward. So I do have a question here, and I'll address it from Ron Wilson. So it indicated Pennsylvania, California were among those hardest hit on labor claims. How is Kansas doing on that? Unfortunately, Kansas, we're not down at the bottom in terms of those initial claims. We're somewhere right in the middle to just below the middle from what I've been able to gather. I think a lot of that just goes to, we do have manufacturing in this state. Boeing and Wichita, that is a part of us, and that certainly is a big sector within Kansas. So we were hit, but not as hit as hard as those other states. Great question. And then the other question from Austin is, do we think we would see a V bottom or a W or an L bottom in equities. Where's the stock market going? Boy, that's a great question. And I get it a lot. And unfortunately, I don't have a real good answer. I hope to see a V. If we can have the pandemic, we'll likely have that.
Brian, I'm going to break in. I'm sorry. We lost you for just a little bit, so you might want to just go back and restart that.
Sorry, you on the equities piece?
Yes, that's what I was after.
Okay, sorry about that. So anyway, go back and the question was on in equities, are we going to see a V bottom, a W bottom, or an L bottom in equities? My response would, first of all, be I wish I knew, but I don't. The thing that really is key to this is controlling and containing this pandemic. Markets are going to be spooked, and they're going to be spooked because they're afraid people cannot meet their financial obligations. And if that's the case, we could see it continue to go down. Right now, the market believes the stimulus package is there. We're starting to see it rebound, and hopefully that trend continues. There could be a lot of pent-up demand if we get through this fairly quickly. I don't know about you, but I'm to be honest, I'm sick and tired of being in this office and giving lectures like this. I kind of want to be out. I'm a bit of an extrovert. I want to go out to eat. We could see tourism spike. I mean, that's a realistic scenario that could happen. But the other key to that, once we get the pandemic, people have got to get back to work. We have got to get that labor force moving again. It was very strong before. People need to have that money in order to go out and start spending again. So I would hope to see a V type bounce. But again, we need more information. So a question from Dan, if inflation does begin to heat up with all of this new money, will it not put pressure on the Fed to raise interest rates to put on the brakes? If we do have that new money flow into the economy very rapidly, and we do have that pent-up demand that comes and starts chasing, and we have all this access to free credit, Dan, you're absolutely right. That could happen. That is a scenario. By definition, inflation is too much money chasing too few goods. Now, I do want to clarify, and we also know, we learned from Paul Volcker that the way you fight rampant inflation is you target the money supply, you restrict it, and you just let interest rates go through the roof, and nobody wants to go there. Now, the one thing that I always want to clarify with what the Fed is doing with their balance sheet, and as they're expanding it very rapidly, those funds cannot enter into the commercial banking sector. If they did, that would be without question too much money. However, they control that. It's excess reserves that are held at the bank, but they cannot lend on those. So those funds will not enter into the market. So the question, would be is we've got to have growth. We've got to come back for that. Great question. Candace has a question of, do you see the decline in gasoline demand bringing the CPI down by a relative amount, or will COVID counter this effect? It's certainly possible. We're not traveling as much, so we see gasoline demand going. The oil markets have really taken a hit. How it affects, CPI. Typically, we wouldn't see that with what the Fed would follow. Fed follows core inflation. They don't look at things that are tied to energy markets or commodity markets because they are so volatile and are affected by things, but they focus and hone in on core inflation, wages, salaries, rents, those things that stay fairly stable. So I don't think what's going on in the commodities and energy is not going to enter into the Fed's decision-making, and it really shouldn't. But, it is going to have an effect, certainly for us, as consumers and folks who use those products. From Daryl, the question is, what's your opinion on potential for consolidation in the ag sector to ethanol farming and ranching? If we continue to have depressed net farm incomes, if we continue to see, the competition, the expense, the scale, I think that is part of the future as we begin to adopt a lot more technology and start to put that to use. I know a colleague of mine, Terry Griffin, has a lot of discussion and good stuff out there on precision agriculture and using technology. It's only going to ramp that up. We won't need as many folks to farm as much because the ground is without question going to be farmed. It'll just look different than we have seen in the past. And those are all things that are going to fuel that consolidation across the board within agriculture. We've seen it happening now, and it's only going to continue, would be my opinion and my projection going forward.
Brian, I had a question that was sent to me on the private chat. They'd like your opinion on what this large financial stimulus will do to the value of the U.S. dollar. And I'll quote, "I would think all else being equal that the U.S. dollar would move lower. But if other economies are all in catastrophe or at risk, the U.S. dollar may stay relatively strong compared to other currencies. This has an impact on U.S. ag exports."
Yeah, exactly right. Yes, we would think with the stimulus going on would help push it down, but what we're seeing is this flight to safety is beginning to happen. So we're actually seeing the value of the dollar is increasing, is going up. So yes, you're right. That is going to have an effect on us on ag exports, but it goes back to that supply chain disruption. If we don't get this thing under control and we can't get our products out, it's not really going to matter a whole lot what our prices are. If you think about cotton, I know the textile industry in India is taking a big hit right now and looking to start shutting down manufacturing plants. So that definitely will have a negative, well, it should. I haven't checked cotton prices lately, but I would imagine that would have an effect on those and negatively impact our cotton farmers. But yes, so yes, we are seeing currently actually the value of the dollar go up because of all the disruption everywhere else, and people are flocking to us as a safe haven. So I'll take this question here as everyone else. I would put a plug in if you want to think about other questions, on grains, livestock, land values, please feel free to type it in. We're here. That's why we're doing this series. We want you all to have a chance to ask questions. And we definitely have some folks here who can respond. So the question is, what long-term consumer impacts may evolve from the crisis? From Philip. That's one that I've thought a lot about. And I think the way to maybe frame it up is what we're doing right here. I mean, I'm sitting in my house, my office, doing a Zoom session with 100+ people. We got Glenn, Dan, and Michael too. Rich is running it. We're getting maybe more used to this online environment. How does it affect online grocery shopping? How does that affect us as we get used to that? What about, are we going to have a structural change within because of this structural unemployment? All these people who are out of work, are they going to maybe get left behind because a whole new set of skills is going to need to be required because we start figuring out how to use technology in ways that we've never figured out before? I know education is certainly having these questions and is working through it. So I think there are some longer term consumer impacts that we could figure out. Hopefully it'll be for the better of the U.S. economy, but it could create some potential pain here. I don't know, Glenn, do you have any additions or reactions to that?
No, I agree with everything you said, but I want to highlight before COVID, at least in my opinion, there was a lot of evidence of growing protectionism and populism in parts of our society and around the world for that matter. It would not be surprising if a human response to a pandemic that is global, that trend also continued, that there'd be a little bit of each country hunkering down, questioning the value of international trade more than we had, say even just a month ago. I highlight that because certainly everybody on this call recognizes that ag exports are very important for farm economies. And I think anything we do that slows us, returning to some sense of normal international trade is concerning. So that's as much resident as it is consumer, but public sentiment on the role of trade, I think, is very important for us all to keep in mind.
Yeah, no, I think you're spot on. So we got another question, and I think this is a good one for you, Dan. If you want to take a look at it from Emily, commodity markets starting to stabilize. You look at the corn market really based on ethanol, from Austin. So Dan, do you want to take a stab at those?
Yeah, you look at the latest USDA supply demand balance sheet for corn, and of course this number's probably going to get adjusted downward, but they were projecting about 5.425 billion bushels of U.S. corn use, and total use was just a little over 14, so that's 38%, 39%. The thing about ethanol usage was that it was so inelastic and such a driver, that tended to support that whole complex, and you saw that in the basis levels all through since last summer at the ethanol plants. Strong basis levels, just trying to pull corn in because they had they had this driven demand, but so how much does it impact things? Quite a bit. And I think that the previous earlier estimates of how much corn production, how much corn usage might be reduced by ethanol plant closures were a moderate 200 to 300 million bushels. 2 billion gallons, several hundred million bushels. Well, this will be a real challenge. The longer this issue goes forth, the more losses accumulate for ethanol plants, the tougher it is for them. And do you get to 500 million less? Do you get more than that? Well, all of that, just given our productive capacity, just ends up to be an ad hoc statement, just buries us in corn next fall. We need to have strong usage to not be overwhelmed by just excess supply. So in answer to your question, it's something to be worried about if you're interested in the corn market and the profitability of farmers in Kansas, corn growers in Kansas and all over the country. Did that answer your question? Is that getting at what you were thinking there, Austin?
Well, and I also think too, Dan, that Shelley chimed in and you touched on it there at the end of, could we see more ethanol plant closures?
I think so. One thing, Emily, right ahead of that, asked, are commodity markets starting to stabilize after about a week of growth? There's some interesting things happening underneath the scenes in the soybean, the wheat, and even the grain sorghum markets. The one that's suffering the most right now is corn. As Brian, as you mentioned, that logistical issues were something we were worried about in terms of other country, in terms of getting our crops to ports. Gosh, Argentina, Brazil, they're having huge problems. So in kind of the whiplash backside of this, the logistical issues that our competitors are having, if anything, are tending to push business back towards us if we can get it to the ports to take advantage of it.
There was a question from Michael talking about in a relative sense of the monetary and fiscal stimulus the U.S. has taken and how aggressive has China been. Do you see a return to growth of the Chinese economy? I'll take a stab at it, but I honestly don't know exactly what all China did through their shutdown. I know that they shut down, and from the reports that I'm hearing, they're beginning to start up the factories again. So could their rate of growth enter into that similar pre-rate crisis? It's possible to see where it's at, but they definitely need to have somewhere in order to ship their products to. So we need to see the entire globe move through this. Hopefully it won't become a global recession. Some are predicting it will, but hopefully it doesn't come to that we can move, and it would be good to see the Chinese economy pick up again. But to say exactly where it's at, I don't really have a good sense or good estimate to provide.
This is Dan, if I can add in. China, there are some signals that they feel they've been caught short on corn supplies. Now, it's hard to believe given the disease issues they've had in their swine herd, but we need to double check. I hope it may be maybe just rumor, but it's worthwhile to note that the market is digesting the potential, the issue of China adjusting their support structure to encourage more corn production. So that, what's happening in grain sorghum, whole number of things that are just pretty dynamic right now in the feed grain and oilseed markets.
Michael, do you want to take the net farm income question? What do you think is going to happen?
Yeah, I just had to figure out how to unmute. So, Louise, what's going to happen for net farm income for this year? That's a tough one. We've been watching net farm income slowly recover from our low in 2015, and part of the reason the net farm income for 18 and 19 was as high as it was because of government payments, the market facilitation program payments, so MFP. What happens this year if we don't get MFP, as well as just sort of the chaos that's ensuing from COVID-19, makes it really hard to predict what net farm income is going to look like. But I was nervous before we had this pandemic hit about what 2020 farm income might look like without an MFP payment to subsidize it. So this doesn't necessarily make me feel more, better about it. So I'm not going to put any numbers out there and try to spot you on what I think the net income will be, but I think it'll be down from 19.
Good.
Hi, Louise.
Glenn, do you got something to add?
No, I was just going to tackle the next one for you because you're going around robin, so I'll help answer. So John made a comment. He read that many countries are stopping exports of food in order to be dependent or not being dependent on others. In many ways, this is what I was alluding to. And it is perfectly rational to take care of your own food security here and now. That's exactly what Americans are doing when they try to hoard toilet paper, right? It's the same primal instinct to take care of what's close. So I'm not trying to question that. That's a debate we can have offline if you like. My concern in a more macro sense is how many countries will do exactly what you raised and basically just kind of shut down the border, initially in the spirit of stopping the disease. Secondly, in the spirit of making sure we have enough food for those countries that do produce enough for themselves. And most importantly, the long-term economic perspective, how long will those closures continue? So are we going to build a kind of an acceptance or buy into the mantra of populism that allows for those closures to be not just days and weeks, but months and years? So, I mean, if I could give you 3 things that keeps me up at night, that would be on my list, is that this becomes a shutdown in trade post-COVID that creates much bigger problems. So I didn't have hair before I signed on, but I lose a lot of hair thinking about that.
The other thing to think about too is the effects it has on food price inflation. Through the 2008 financial crisis, we saw some food price inflation here in the United States, but not near what it was in those developing countries. Those countries who do need those food imports for them, for their economy, they get hit the hardest. So that's another layer to this to be thinking about, in addition to everything Glenn brought up too. So on the other side, see very high interest rates from Luis. Will we see, very high interest rates like what maybe we saw through the 1980s? Again, it's hard to predict interest rates. That would be, as I would predict and put in my opinion, to have interest rates that high would be a black swan type event. We went through a really rough patch in the 2008 financial crisis. Interest rates were very low. We didn't really see a lot of inflation. It just wasn't there within the market. And now we're experiencing another decline, another disruption, and we have more stimulus coming in. So I know there was a question earlier about will interest rates stay low and for how long? I mean, if I was to predict to say, well, I would anticipate the zero bound that the Fed has pushed us to for the remainder of this year, if not into next year. But to try and predict those really high interest rates to combat, really high inflation, that would be a black swan type event.
I'll just add to that I think that's one of the having interest rates go up. They don't have to be really high in order to cause some problems with the ability to repay notes. And I think that's why a lot of lenders are looking at restructuring loans into taking short-term and debt and turning it into longer-term debt just to fix those interest rates, because we don't have to see 18, 19, 20% interest rates for people to be unable to pay back notes and get into financial problems. But just to see them go up a few points could cause some problems for some of those folks that are on the edge. So I think that's one of the reasons we've seen bankers looking at restructuring as an important part of their game plan for some of these borderline farms and ranches.
Yep. No, that's a really good point, Michael. Do you want to handle the farmland prices? So from Luis, or what is the impact of COVID on farmland prices?
Yeah, I keep muting and then trying to talk. It's not working. So what's the impact on farmland prices? I don't have a good sense right now. What I'm trying to get is more recent farmland prices from the first quarter. We saw farmland prices, I've seen them drop a little bit in 2019 relative to 2018. So we're a little precarious, but you'll still hear about auctions in different parts of the state that are strong. If the right piece of ground comes up for sale and it's got a good location and it's good ground, it's still bringing pretty good money. So it's a little bit hard right now to see what is going on the overall state of farmland prices. I think one of the biggest drivers is going to be the supply of land. So how much land people are actually going to go ahead and put up for sale right now. That's probably the biggest driver of farmland prices, is whether or not people are going to feel the need to put up a piece of ground for sale and actually see what happens to it. But I'm going to try to get those farmland prices from all the way through 19 and hopefully the first quarter of 2020 processed before we meet again on I think I'm on April 16th or 19th, and talk about that in a little more detail then.
That's great. Dan had the comment of, could the Fed actually be more concerned about preventing deflation than stimulating inflation? Yes, the deflation piece that they're really concerned about is those credit markets. They have to unclog them. That's all the different facilities, credit facilities that they are creating, is to stave off deflation. But they really do want to stimulate inflation. Earlier I said it's over 350 billion, or I think it was 357 billion in treasuries they are going to buy just this week. And if you have heard the term monetizing the debt, that's when a country's central bank purchases its country's debt. Well, the Fed is the U.S. central bank buying U.S. treasuries. We are monetizing the debt. And what that does is they're trying to create inflation. I mean, without question, by doing that, trying to stimulate that inflation and also to lower the longer end of the yield curve, try to get things going. So it's both parts. Deflation really focused in on on those credit facilities to get rid of that, get things flowing. But then they're on the inflation end, looking at purchasing those U.S. treasuries. So is there any other questions from the audience?
So Brian, while you're doing your last call, I think your presentation was on point and answered most of the questions directly. So the fact we've gotten through them is a compliment to your presentation.
Thanks. Michael, do you want to handle the PLC payment?
I think a potential PLC payment in wheat and sorghum is definitely there. The question of whether or not we're going to get a PLC payment in corn and beans is a little tougher to predict. As we had mentioned when we were doing the Farm Bill programs around the state in January and February, it wasn't necessarily looking like PLC would pay out, but you have to remember how the marketing year average price is calculated, and that marketing year average price has to fall below the reference price in order for PLC to trigger. And so I'm going to not try to get too far in the weeds here, but basically what has to happen is that marketing year average price is built on the amount of bushels marketed each month across the country. And so it's a weighted average of prices multiplied by the proportion of the crop that's being marketed. So what happens is we're getting into the part of the year where fewer and fewer bushels are being marketed. So even though prices are going lower, that price isn't going to factor into the average as with as big a weight as it did in, say, November, December, January. And so it's kind of tough for corn. It's possible that we'll get a PLC payment, but I don't see it being terribly big for 19. The question remains, for 2020, what this is all going to look like and how long this is going to last.
Good. There was a question on the fiscal stimulus. There's already talk of more. Well, yeah, there's probably going to be talk of a lot more. I mean, because especially if this, pandemic continues. My personal feeling is I would rather have the stimulus, let the economy begin to recover. Let's get this under control and then move forward. Who knows what could come out or where it might be targeted. Just in my own opinion, I hope this is enough and then we can move forward, but we'll just have to wait and see. The question from Jason of will the Fed support money market funds so they don't break the buck? They certainly could. I think the Governor Bullard, the board chairman of the Fed or excuse me, not Bullard, but Jerome Powell has come out and has said very bluntly to the market and to everybody that he is going to do what it takes. We have got to provide stimulus. I think if you have read through the different papers where he came in and quote unquote became a direct lender to businesses, that's unheard of. Basically, he just went around everybody and said, okay, Treasury Department, you can't figure this out. I'm going to do it. Because I feel it's the right thing for the economy right now. So everything is really on the table when it comes to monetary policy. We'll have to see, how it all develops, but, Powell has spoken pretty forcefully about what he's going to do to try to get the economy through this disruptive period. So John has a question. Are any concerns about the stability of local community banks or the regional ones in a crisis like this, since they're not too big to fail? Absolutely. When I was at the Fed, that was one of our, at least in the Federal Reserve, the Kansas City district, the 10th district, we were very outspoken about is we did not have a lot of the too big to fail banks. Then we got Dodd-Frank, that there was supposedly, to break up the too big to fail banks. And all it did was raise the cost of being a banker and running a bank. And it really put the squeeze on those small guys. So if anything, it created too small to succeed. And I know there's some research out there. Brady Brewer at Purdue University, he has put some research out on that to kind of show that in the data. So is it going to put a squeeze on those smaller ones and create some additional hardships? Absolutely. It's going to be a tough go of it, but hopefully we can get through it quickly. It just goes back to those good management practices that need to be implemented, not just for farmers and co-ops, but also for bankers as well. So any other questions, comments? Dan, I think that's looking at crop prices, and I would say go ahead and get out your crystal ball and tell us what's going to happen.
How much of that is domestic demand and how much of it's foreign? Well, it's a mix. When you look at wheat, last couple, until this year, until what we've just seen with bread flying off the shelves, we've had so-so domestic demand, pretty docile, from millers, and wheat was either put in storage, and a lot of it was, or it went to export, and the exports were failing. So here, what we've got right now is a hard hit at the grocery stores, and suddenly the millers are going like crazy to meet domestic demand for bread. So it's if you asked me that before this happened, I'd say, gosh, I wish exports were higher, but you have to, given the stability the world had from 2013 through about 6 months ago, we were struggling and failing. So wheat was struggling. So you asked me a straightforward question, I've talked for 2 minutes and haven't given you a straight answer because it's a mixed bag. But I would think in the longer run that these issues that wheat faces, and I probably have 3 representatives of Kansas wheat on this call, they're pretty hard to overcome. Here now we've got a financial crisis and the value of the dollar is still holding up well. So wheat has to go for value or some other type of strategy that works. So I think the reason wheat's been struggling has been because we haven't been competing well in foreign markets. So that's just that big part of it. Wheat, let's see, we need strong domestic crude, wheat and corn and feeders. On the corn side, there is hope with recovery that our livestock sectors, and Glenn can speak to this, will be profitable and pull that demand in for corn, et cetera, and that ethanol will someday recover from this. I think we still have a positive outlook in the long run, but we'll have to band-aid and limp our way along here in the shorter run. So things are damaged and hit right now, and the world's kind of flipped. Now wheat's strong and corn's struggling. In the longer run, I'd expect probably just the opposite of that.
So as a quick context on the cattle front, 10 to 15% of our value for cattle comes from exports in recent years, slowly growing. It's north of 20 and at times north of 25% for swine. So the immediate implication of a hunker down, we can't trade, is a bigger deal for the swine industry than it is the cattle industry. But in both cases, there's an awful lot of meat in the system that if we're not able to export, those pounds stay at home and they depress prices. I can't come up with a scenario that gives you cattle prices like we had in 2015 anytime soon. So we'll save that Dr. Bear talk for 2 weeks from now, but we're a ways off of the fundamentals from that, I think.
Yeah, good. Well, one thing I got to do, and I got to do this because I got to pull this over here and hopefully you all can see it on the screen. If you look right below Dan, that's my mom. So my mom has been on this webinar this entire time. So I can't see a mom. Hi, Mom. So I have to do that. I gotta say hi to your mom. But anyway, all right.
We had thought you had invited your whole family just to puff up the attendance, but I wasn't going to say anything.
So, Brian, that's also why I gave you a compliment. Your mom needs to hear people give you compliments.
It's no fair, Brian, when it comes to evaluations, okay?
That's right. That's right. Yeah. So Mom, bump up those evaluations. Tell the family. Well, just to wrap up here, thank you all for spending your evening here with us. We're going to come back again next Thursday. Dan will be the lead presenter, kind of what I did. And then, of course, we'll have time at the end to answer questions just like this because everything is very fluid. We're trying to figure it out as we go. So with that, thank you very much, and I'll turn it over to Rich to sign us off.
Folks, thanks much for being on here. I'm sorry for the extra hurdle I threw up in front of you. I apologize, and I've removed that. So we look forward to having you next week without the hassle of getting on like you had tonight. Thanks much for joining us, and we'll catch you then.